I'm ready. Hi, everybody. I'm Tiffany. I have been in the financial field for 3 years. One of the aspects is insurance. I sell insurance and I have for about the past 3 years. So today, I'm tasked with the privilege of giving you the basics of insurance. This is like an introductory video just to get your feet wet, to let you know and to help you get started on your journey towards the importance of insurance. So what is it? Essentially, you pay a company and they protect you in the event that something happens to you. That's like the most basic way to think about it. But also think about it in this: insurance protects your income. Something happens to you, the financial loss, the company, guess what? They reimburse your family. So then it protects the money you would have made had you been living. What does it do? It also builds wealth, generational wealth. Wealthy families, they have large policies that when upon their untimely death, whenever that may be, guess what? They leave their family, the next generation, a nice financial beginning. And it's also, can think about it as in terms of a safety net, just in case. I'd rather have a safety net under me than not. So what's the hard truth? The first hard truth is everybody is going to pass. No one knows the time, no one knows the hour. That's the hard truth number one. Hard truth number two is, guess what? Almost half of the families in US, they would be impacted if the primary earner were to pass away. The financial loss, that's over 50% of families in America, and that number goes up in the Black and brown community, let's be honest. How many times have we seen people, someone passes and now they're doing a GoFundMe? The GoFundMe just tells people that, guess what, we didn't have a policy in place just in case. See, safety net. So let me ask you a question. What if you had a toaster that popped out $5,000 every single solitary month? Would you make sure that toaster was insured? Like, you would make sure if it breaks down, if it starts burning the money, what would you do? You would make sure that it's insured, right? With no questions asked. You would pay $100. You would even probably pay $200 to make sure that your $5,000 toaster was insured. Well, guess what? The hard truth is you're the toaster for your family. You can substitute whatever monetary number in there, whether it's 1,000, 2,000, 3,000, 4,000, 5,000, whatever it is, you're the toaster for your family. So now immediately you saw the picture and you're like, yes, I'm going to insure my toaster. But you're not insured. Think about it. So now, when we talk about insurance, there are two types, meaning two groups. We have group insurance and individual insurance. Group insurance is insurance that is typically offered through your job. What happens? Your employer, when you sign up, like when you start to work, they offer you some form of life insurance. Now, the thing with the group policies is this: the company owns it. They determine how much insurance. It's not based on your family's needs. And in the end, it can be costly, because if you're ever terminated or you leave that job, guess what? You don't have anymore. You don't have that policy, because remember, you don't own it. The job owns it. Now, I'm not saying go to work tomorrow and get rid of your group policy. Absolutely not. If it's free, take the free stuff. Keep your group policy. But in addition, you're going to want to have a policy that you are the owner of, not the company. And what happens is, let's say you get fired on a Monday. Guess what? Now, when you got the policy, you were 25. When you got fired on a Monday, now you're 35. Guess what? Because you didn't have your own policy, now that policy, your new policy, is going to be more expensive because you're not 25 anymore. Had you got a policy that you owned at 25, it would have been much cheaper. That's why group policies can be more costly for you if you don't have a policy that you own. And that brings us to the next one, which is individual. You own it. It's based on your family need. You determine the length of the policy. not just based on if I'm working here or not. So just keep that in mind. Keep the free stuff, but have a plan that you own, that you are the owner of. So now, when you think about insurance, think about it like this. When you're younger and you're starting out in life, you have what? We have something called decreasing responsibility. In your early years, you probably don't have a lot of money. But in your younger years, you have much more responsibility. So guess what you need earlier in life? You need much more insurance coverage, because I just have so many more obligations when I'm younger. But as you grow and as you get older and you become more financially stable, financially wiser, those financial responsibilities should lessen. And guess what? I don't need as much coverage now that I'm older. But in the beginning, while you're young, while your kids are young, while you have a lot of debt, while your mortgage is in its first few years, you want to make sure all of those things are covered. So think about it in your early years. I need lots of coverage. And then guess what? As you get older, you can reconsider and think about it. So now you're like, okay, Tiff, I agree with you. I see it. I need insurance. I don't want to leave my family out here. How can I think about how much I could possibly need? So one way is to think about, first, how much debt am I leaving behind? How much is my estate going to owe? You don't want to leave your family money and they have to all pay old bills that you owe. So think about how much debt how much debt would I leave behind in the event something happens to me? Secondly, think about how many months of income would I want to leave my family? Do I want to leave them 2 years worth of my income, 3 years, 4 years, 5 years, 6 years? So that plays a factor. How much money do I want to leave them? Because remember, 50% of families within the first 3 months would be financially devastated. So you want to think about how much money do I really want to leave them to live off of? Secondly, is a mortgage in play? Am I leaving them a mortgage that needs to be paid off? Or if I don't, if I don't have a mortgage, is that something I want them to be able to afford? Because that's another thing. You may want to leave them money so they can purchase their own home. Again, insurance is a wealth builder. That's one way, ownership. You could leave them enough money. Guess what? They could buy a property, buy a building, buy several buildings, buy a home that they could live in. That's a factor to either pay off an existing house or potentially to give them the money to finance their own home. And then the last one, if you have young kids, is how much money do I want to leave them towards their education? So you want to think about, okay, does my kid want to go to private school? Do they want to go to a private institution? Are they going to go public? Are they going to a 2-year, 4-year? So then that can help you figure out how much you need to leave them towards their education. So now if you're like, Tiff, I don't think my little Jerry gonna go to college, you can still factor this in to think about, okay, how much would I like them to leave them to start a business? Or how much would I like to leave them to give them a leg up as they go into adulthood? So that, again, it's a generational wealth builder. So think about it in those things. Remember, how much debt, how much income would I like to leave in my absence? How much money would I like to leave towards an existing mortgage or potentially buying a mortgage of their own? And how much would I like to leave them for their educational expenses? So now, in the insurance industry, there's 2 types. You have term insurance, and then you have something called whole life, cash value. Those are the same. So now term insurance is the first type we're going to look at tonight. So term, it sounds just like the name sounds. It means that for a specific amount of time, you will be insured by the insurance company. Terms can be as little as 10 years, but they can be as long as 35 years. So when it's explicitly about a specific amount of time that the company that you'll pay, and the company will they will insure you. So now when you think about term insurance, I'm going to tell you, the key is get it while you're younger, because that's one of the benefits of term insurance. It's already affordable, but it's extremely affordable when you're young and healthy and you get insurance. So you can get a lot of coverage for a relatively small amount of money. Okay. So now with a term insurance, you want to think about, okay, so Tiff, I think I'm going to live longer than 10 years. So then when it comes to term, you want to think about, okay, ask the agent, what are the renewal terms? So if I want to continue this policy beyond the 10 years, what will happen? Will my rates increase? Will they decrease? Do I have to prove that I'm healthy? So you want to ask those things, like, what are the terms of renewal when it comes to term? Now, because term is so affordable, you get a lot of coverage for a relatively low amount. If you're wise, what you'll do is you'll take the money you save on not buying a more expensive policy, and you'll invest that difference. So the key is buy term and invest the difference. That way, again, remember I talked about this within the group and individual. You control your investment, okay? If you're wise, buy term, take the money that it would have cost you if you bought a more expensive policy, and invest it in an account that you control. There are insurance companies out there that can definitely help you with that. Okay. And then another positive about a term insurance, that the rate is stable. For the length of the term, the rate will stay the same. It won't change on you. For general purposes, the rate is stable. So again, term, it's insurance, is set for a specific time. But one of the biggest bonuses is that it's affordable. You get a lot of coverage for a relatively low amount. And because you are saving on what you spend every month, you can take that money, and now you can not only have Nikes on your feet, but you can, if you're wise, now you can have Nike stock as well. Okay? So remember, get it while you're young. Make sure you are covered, your kids are covered, okay? If you're married, that your spouse is covered. And remember, there's 4 things you want to think about: how much debt, how much income, an existing mortgage or a potential mortgage, and education, when you think about how much insurance do I need. All right, y'all. Y'all have a good night. Peace out.